Well, good afternoon, ladies and gentlemen. Happy Friday, October 2nd, 2015 to you all. It's great to see you all here for our Friday afternoon Power Options Radioactive Trading Open Forum Q&A session. Hopefully some of you here on the East Coast aren't getting too drenched. As the rest of us. I know there's been a lot of problems down in Carolina, of course, Florida into Georgia, things of that nature. Up here we've had rain for about 7 hours now, 7 hours going on 8. It's probably going to rain through the weekend up until Sunday morning, but we'll see how that all pans out. Well, for today's presentation, we want to begin off first with describing what exactly is Power Options. Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. We support tools in over 23 of the most commonly used option strategies, patented search tools, analysis tools, research tools, as well as comparison tools as well. Once you have identified the position using the search tool, you can quickly do further research and analysis and compare the risk and reward and run basic what-if scenarios on those positions. We also offer a powerful set of portfolio tools to help you paper trade, track, manage your positions, and evaluate rollouts and adjustments as well. Inside Power Options, there are countless educational articles, help pages, help videos, and archived webinars to help you get more familiar with the tools on the site, as well as the various option strategies and options concepts as well. Now, Ernie Zeriner created the Power Options tools back in 1997, so we've been in business for about 18 years, but everyone here on staff at Power Options uses these tools to trade their personal account, myself included, so we have many more years of combined trading experience. For those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I have had the great pleasure of working with Ernie Zeriner and the Power Options staff for the past 12 years. I do handle a lot of the education, of course, and the coaching sessions. Those of you that are currently on your 14-day free trial or subscribers to Power Options know you can schedule one of those coaching sessions at any time. I have co-authored 2 books with Ernie on investing. I, of course, host all the webinars. And I am versed in all strategies on Power Options. However, there are certain strategies that I do not trade in my personal account. Things such as naked calls, short straddles, short strangles, iron butterflies, and just all call or all put butterflies. And those positions just don't match my personal risk-reward tolerance. However, if you do have questions about those, we'll be more than happy to show you the tools or discuss the basic strategy. Now, our process and procedures for this afternoon's presentation. When you logged on to the webinar, the GoToWebinar, GoToMeeting platform would have appeared on your screen. Inside that platform, of course, is a question pod. You want to use the question pod to send your question to us. Please feel free to ask as many questions as you want. We're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. However, if we have a high volume of questions, we'll be more than happy to stay online and handle all the questions that came in. Your questions can really be about anything. If you have questions about general option strategy, comparing one strategy to another, what's the difference between a naked call and a covered call? Is a collar really a parity trade to a bull put credit spread or a bull call debit spread? If you have questions just about volume, open interest, the Greeks, volatility, for example, that's all free game as well. If you have specific questions about the tools on Power Options or the concepts of the radioactive trading techniques, please feel free to ask those as well. Now, our basic ground rules: don't be shy. Please feel free to ask any questions that you want. This presentation is designed for you to have an open and free forum to have your questions answered. Be patient. There may be 1 or 2 questions ahead of yours, but as we mentioned, we will try to get through them all. We also want to encourage you to feel free to help us help others. So if a question comes in from one of our attendees and I give an answer based on my market experience and conversations I've had with other Power Options customers and options traders over the past 12 years, but you feel that there's something that maybe I skipped over, or something that's a little bit more important to consider when doing an adjustment or looking at a strategy, please feel free to share that with us. Send it to us in the question pod. and we'll make sure to share that with the rest of the audience as well. Most important, let's have fun. Let's get some good education under our belt and go forward into the weekend and look forward to see what's going to happen next week. It's a strange day today as the jobs report came out and the market sort of took a tumble, and then before you know it, it had already kind of recovered, and a lot of stocks were up 2 or 3 points from when I initially got in. So sort of an overreaction there to the report, and then sort of settled back down to normal. So we've already got a few questions coming in. So let me go ahead and navigate over to the PowerOptions suite of tools. Okay, what we're looking at here, of course, is the basic layout of a trial account. And our first question comes in from Alan. And he says, open stock position is at a loss, but recovering slowly. How can we accelerate the recovery through options and earn some income along the way? Perfect question, Alan. What we're going to look at is what we call the stock repair tool. So let's see here. I don't know your stock, Alan, so I'm going to use my stock, one of my stocks I'm in right now. We saw today, in addition to the stocks recovering, but the financial stocks were hit pretty bad, especially some of the trading stocks that have a lot of debt and different areas. E-Trade, for example, is one of them. This is a position I'm in on a married put where I have a guaranteed profit of 2.6%. Well, let's go ahead and take a look at the chain for E-Trade right now. And we see E-Trade is at 25.75. It's only down 46 cents. But if we take a quick look at the chart, so anytime I want to do further stock research, I can always use the more information buttons. Let me adjust this here. There we go. I want to use the green pen for these. So on PowerOptions, I can use the more information button there to evaluate the position. Let's go ahead and take a look at the basic stock chart here on big charts. So we see the stock has been trending downward. Let's adjust this a little bit. Just look at a 6-month chart. And we'll put in some basic indicators. I'm going to put in a 20-day SMA for right now because I like to look at the Bollinger Bands. And we're going to use MACD as well, maybe RSI, and of course just basic volume. All right, so let's go ahead and take a look at the 6-month chart. Now we see here, that's probably too much, but we see here recently the stock was right around 26 even a few days ago. Let's go ahead and call that about 26.25 or so. And the stock's, of course, trading at 25.75. Not a big drop. Let's go a little higher. Let's put it at 27.50, and the stock's at 25.75 right now. All right. So a few days ago, the stock was trading at 27.50. Now we have various weekly options, 7 days out, 10 days out. Let's go to standard October expiration. All right. So if my cost basis, remember, was at 27.50, bought into E-Trade a few days ago, and we saw the drop recently. So let's say our cost basis is 27.50. One would think that, okay, well, we can sell a 26 call to generate some income now. Well, that's a little dangerous, isn't it? The stock's at 25.75. If I only take in 60 to 70 cents, if we get assigned at 26, or the stock moves above 26, we may force to be assigned on the position. We'll get 26.60 back, but that's a 90-cent loss guaranteed on the position. Well, it's 27 is trading right around, now let's go ahead and call that about 30 cents that we could get on the bid-ask spread. So if we sold the 27 for 30 cents, we get a little bit of income, drop our cost basis down to 27.20. Hopefully the call would expire, but if it moves back up, then we'd get assigned. Well, is there a better way? The stock repair tool is going to try to build for us a ratio call spread where we're going to buy one call and sell two. Now, if you're in a restricted IRA account, you think, well, I can't do a ratio call spread because that would leave one call naked. Well, not in the stock repair concept. You're essentially doing a bull call debit spread and a covered call because you already own the shares of stock, so that second call is not naked. Let's take a look at what I mean. We'll go to E-Trade here, and I'm going to click on the stock repair. You can also access the stock repair through the signature tools menu, the volatility skew, market sentiment, spread chain, long option finder, and so forth. Well, let's put in a simple 100 shares at our cost basis of 27.50. Let's go ahead and run that in. Now, we go out to October here. We have a repair available for October, and we see some further out in November as well. Now remember, my original cost basis was 27.50. Here we see that the new break-even for this repair is 26.46. We're only at 25.75 right now, so rather than needing the stock to go back up to 27.50, with this repair, I'd only need to get it back to 26.46. Well, how does that work? Well, when I see an available repair, I'm going to go ahead and click on the Repair Details button, and this is going to give us the basic description of our stock repair. So what the system did is it found repairs where we could buy the 23rd of October. So it's a weekly, it's a week after, it's about the fourth week out. It's the week after standard October expiration. So the 23rd of October, $25.50 for $1.27. At the same time, we can sell two. So, but if I had 200 shares, I'd be buying two October 25.50s and selling four of the October 26.50s. But here we had 100 shares. So I'm going to buy one 25.50 call and sell two 26.50s at 68 cents. That's going to generate $136 in premium. We're paying out $127. So Alan, in this case, I'd only be receiving $9 worth of premium, or 9 cents. But what's the advantage? Well, at 26.46, the stock's trading at 26.46, what would happen? Our 26.50 calls would expire worthless, and our 25.50 call is going to have a value of 96 cents. Remember, our cost basis is still 27.50. So at 26.46, we're $1.04 down. But we could sell to close the 25.50 for 96 cents. We keep that little 9-cent net credit, so we'd have a total profit of break even. We'd be back to 1 cent. But the stock's at 26.46, still $1.04 below where we originally purchased. Okay? Now, it's great to see things numerically just to get a gauge of what's going on, but as we all know, it's better to see things graphically. So we're just underneath where we saw the repairs. Let's scroll back up to our credit repairs. It's better to do the credit repairs than the debit, but sometimes if you run this trade, if you run the stock repair tool, you might not see any credit repairs, but debit repairs may be available. But now that we clicked the repair details and we saw the action, we'd have to buy one 25.50, call it about $1.27, and sell two 26.50s at 68 cents. But now if I go to the Analyze Trade feature, this takes us to the profit and loss chart where you can see a graphical interpretation of our position. What is our situation for this repair? We are long 100 shares of E-Trade, which is down about $1.75. We're going to buy one 23rd of October 25.50 call for $1.27 and sell two October 26.50s at 68 cents. So it's going to give us a small credit of 9 cents. When we scroll down, and this shows us the basic repair. Now, as I mentioned, essentially what we did is we sold two calls and bought one. Okay, but one of these with one 25.50 call bought and one 26.50 call sold, this is essentially a bull call debit spread. If we did the spread originally, we would have paid $127 here and collected roughly 68 cents here. So we'd have a net debit of 59 cents, and if the stock was above 26.50, we'd get $1 back, so we'd have a profit of the 48 cents. Okay, I'm sorry, it'd be 59 cents, right? So the 41 cents profit on the position. But we did this at a credit because we sold two. But since we own the stock, we simply just have a covered call, long shares of E-Trade, and short the 26.50 call, combined with a bull call debit spread. And if the stock is above 26.50, or just at 26.50, we get the full $1 back from the debit spread, which we actually received at a credit, and then both calls would expire worthless. We could see, okay, both calls would expire worthless, and we get that $1 from the 25.50 intrinsic, plus the stock has moved back up, and we'd be back at break even. What are some of the downfalls here of this stock repair? Adding a ratio call spread, which essentially to your broker would just look like a bull call debit spread with a covered call. What are the downfalls? Number one, you do have a capped gain. Now this isn't the best repair, but it did get us back to break even faster. So on the 23rd of October, I'd want the stock to be around 26.50, so I get closer back to break even or lower my cost basis down to 26.50, and then I can do other adjustments later on. The accelerated part here, the bull call debit spread, helped me get that $1 off my original cost basis of 27.50. Number two, if the stock starts to move up above that, we do have the capped gains, so you would have to look to adjust one of the 2650s, not both. Let the other one stay in the money and close out the debit spread for the full profit of $1 you're expecting back. But you may want to adjust the other short one, especially if you want to stay in the position for longer term. So you may have to adjust the position to stay in it. Number three, what is another con of it? Well, your stock is down. You're looking to repair it because you think it's going to recover, and hopefully it recovered somewhat for you today. But this doesn't do anything to address the downside. If the stock continues to fall, you just took in the 9-cent net credit to help hedge that as well. So there's still a fair amount of downside risk. Okay, but that's essentially the stock repair and what we want to look for here for managing the position. All right, that's one way to go about it. And of course, if we go back to our stock repair, if you wanted a higher net credit and a lower break even, you could decide if you wanted to go further out in time, say to November, where you have a break even of $25.95 and you take in a net credit of 61 cents. You go further out to January or April, but really when I do the repair, Alan, I treat it just like doing a covered call, a naked put, or a credit spread. I want to stay in the shorter term, hopefully under 60 days out in time. But again, with the higher net credit here on the November repair, we take a look at that profit and loss chart very quickly. Now if the stock moves up, we could still have a profit of about $11. Still not that high, but we're trying to get back to break even. And our break even is now dropped to $25.95 if we go out to the November repair as well. All right, so that's just the stock repair tool. That's one of the first places I look if I have a stock that's down. Many of you know, of course, I typically only trade collars and married puts with long stocks, so I also have protection in place to begin with. But if we have a stock that's down, look at the stock repair tool. In addition to that, Alan, at any time, you can go to our free webinars page. It's just going to send it to everyone here. This is always open. It's public. You don't need to have a PowerOptions account or a trial. You can go to powerup.com/webinars.asp at any time to view the webinars. And the reason why I wanted to go here, hold on one second. Long options. I wonder if I put it in option strategies. I apologize, folks. I think I did. Well, there's various categories here in the free webinars page: power options tools, option strategies, and options concepts. Under option strategies, you'll see things such as selection criteria for buying calls or buying puts, managing your long options positions, naked puts, managing your naked puts. I apologize, folks. I'm kind of, is it here? I apologize. Sometimes I get confused about where I put things. In the options concepts, the second one from April of this year, manage your broken stock. In this, Alan, we review the stock repair strategy that we just discussed. When we talk about other ways you may look to repair a broken stock, a stock that's fallen in price, different things you can do, time frames you want to look for, and what tips to use when evaluating one repair over the other. Not necessarily just a stock repair, but in addition to why would I use a stock repair instead of just selling out of the money calls to get my stock back to break even, or there are other more complex strategies that you could use. Go to the webinars page, powerup.com/webinars.asp, options concepts, and take a look at the ideas there under manage your broken stock. All right, second question came in from Steve. I have heard there is a provision put forward by the Department of Labor to disallow options trading in an IRA account. Is this true, and what is the latest status? Yes, this information came out. It was an idea. I don't know if it's actually put into play or if it's part of another bill, but there was a discussion of removing options capability from IRA retirement accounts. Okay, long story short, I think they either want to prevent people from trading their own accounts. Even though we're more active as self-directed investors, they kind of miss out on money on that with the IRA. Do we know why? Of course we know why, because we're not going into their funds, all right? They essentially want you to go into their funds. The brokers want you to go into their funds with your IRA because they feel they can tread it better than you can. And they also want to take, of course, the advantage of the taxable income off so that they can collect more taxes for those of us that are active options traders and are trading in a retirement account. That's my view on it. I don't want to get political on it. However, that is out there. That was floated. Your broker may have sent you an email about it. They may have sent some notification. I have no idea where it stands right now. Steve, I don't know the time frame of when that's going to be voted on or when that's going to be even looked at. by the people that control those policies, lack of a better term. So we encourage you to, if you know, whatever your stance is, we encourage you to be active with it. Contact your broker, see if they have anyone that you can contact to let them know that you're against the idea of removing the availability of trading options in IRA accounts. I don't even know how serious it is or if it's possibly that it would pass. But again, we encourage you to take action on that. Ask your broker if they have someone that you can write to, or that if there's any kind of form that they have that you could maybe sign to promote or go against the idea of banning those, banning that from going through, from restricting options trading in your IRA account. So we encourage you to do that. Okay, I don't know where it stands right now, but we will keep posting information as it moves forward. As we see more information ourselves, we will let everyone know also. Oh, okay. Let's see here. So Ernest has a question on the trade simulator tool located at RadioActive Trading. What does it mean when it asks number of options trades? Okay, let's go ahead and take a look at that real quick. This is over at RadioActiveTrading.com. And if you haven't used this yet, you might want to kind of take a look here, excuse me, folks, at the trade simulator tool. It's a good guide to kind of see where you might end up over time based on your trading goals and what you're looking to accomplish as far as return and win-loss ratio. So at RadioActiveTrading.com, we want to click on the Resources tab. And of course, you can sign up for a 14-day free trial to PowerOptions, but then we can click on the Trade Simulator tool. And what this tool is allowing us to do is essentially we're going to put in some information here. What is our target return for our trading style? What is our loss limit? What is the probability of a gain or loss, or probability of loss? And if we put in a starting amount here, $10,000, and 50% invested into the trade for each position, you can toggle all these different numbers. So let's say that I'm just going to do a standard long stock portfolio. And I'm going to try to close my stock positions when I hit a target of 10%. Don't know when that would happen, but that's what I'm going to look to do. And I'm going to follow sort of the IBD rules, and I'm going to set a stop loss at 7 or 8%. Of course, we all know that stop losses are no guarantee of what could happen. If the stock collapses and drops 33%, our stop order get triggered, but we don't get filled at the 8% stop order. We get filled at whatever the market price is, because the stop order was just a market order to say, get me out of the position if it ever drops below this price. So we get filled at the 33% loss. Now, we're going to assume a 50-50 win-loss ratio just by buying stocks. We're going to start off with $10,000, and we're going to invest $5,000 into each long stock trade. And down below, what we've done here, essentially the computer flipped a coin 100 times. Heads, we win and we make 10%. Tails, we lose, and we hit the trigger point, we lose 8%. So naturally, if we start out with $10,000, we have a string of winners and losers. After the first 4 trades, we have 3 wins and 1 loss. We take our account up to $11,113. Okay, but that was the high. As we factor in more losses, the win-loss ratio, well, being right 44% of the time and being wrong 56% of the time, we have a drawdown of 13%. Okay, let's run that again. A 50-50 probability of loss. We have a winning track record. We're going to be ahead. Okay, and in general, if you want to set that higher, you could. Now, what we're looking at here is what is the difference is if I was doing a covered call, I might still use the 8% stop, but the max return I'd expect if I get assigned is 3%. But I'm going to be a little bit better. Let's say I'm right 65% of the time. I only have a 35% loss, maybe even 70% of the time. We're going to keep that same information. So we run that. I say, okay, even if we're right on covered calls, where we were right 68% of the time, we made 3%, got assigned, and made our max return. We were wrong 32% of the time, of course. Well, we at one point had a winning track record, but over time, even being right more often than we're wrong, we're going to lose money. Okay, because we capped our gains to the upside, we're taking losses, even being right almost 70% of the time, we can still lose money. And we've got some other defaults here. Credit spread, for example. A good target return for a credit spread might be 11%. I make 50 cents on a credit on a 5-point spread, that's an 11% return because my true risk is only 450. We set a stop limit of 50%, meaning that if some trades will go against us, but if we close it for a loss of $2.50 on a 5-point spread, instead of taking the full 5-point loss, of course, and we're going to be right 85% of the time. We're only going to find positions right 85% of the time. So we put a 20% probability of loss. But even there, we invest a fair amount in the trade, but even there we see that we can go bankrupt after 93 trades because of the nature of the credit spreads. And we're not even taking a full loss on the spreads. We're just taking 50%. So here we're bankrupt after 56. Well, what's the answer? The answer is to keep money, you got to be right 80% of the time or more. In fact, I'm going to take this down to 15%. Even being right with looking at spreads that have an 11% return and keeping your losses to only 50% of what you'd expect to lose on the position of the invested amount, if you're right 84 times, you might at one point have an extremely high winning track record, but you might get near bankrupt at one point as well. That's just sort of the nature of the spreads. Now you might say, well, I'm never going to allow myself to take a 50% loss on a spread trade, and that's fantastic. Now, when you said number of options trades, this is Ernest's question. I just wanted to point out the flow here, Ernest, of what this tool is actually doing. If you want to factor in your commissions, I can put in my stock commission of $7.95, and I can put in my option commission, let's say, of $5.95. Okay? But now what does number of option trades means? It means that, let's say I was planning on being in a position for a 2-month period, and I was probably going to be rolling calls or doing, like in the covered calls, for example, I'd be rolling calls or doing things of that nature. So if I sell one and then I buy one and then I roll one again, I might have 2 options commissions, one for selling, one for buying the close, maybe 3 to roll it to another one. So what you're doing there is just the number of options trades is just factoring in your commissions for how many options trades you might do in this time frame. For a credit spread, of course, I'd probably just have 1 or 2. So if my commission is $5.95, I'd put in 2 because my spread commission might be $11. If my regular option commission is $7.95, my broker gives me a discount for doing a spread where it's only $10.95, I would just put in the option commission of $10.95 and put in 1 option trade. Okay, so that's just allowing you to kind of factor in your commissions a little bit better with how many option trades you might do over the time frame you'd expect to be in one of the trades for the win and for the loss. Okay, let's see here. I'm sorry, it's a follow-up from Ernest. As an example, could you show us a married put trade in the trade simulator? Can we add in selling weekly options against the married put? Well, sure. Okay, but let's factor this in. Okay, there we go. The married put, the standard default here on the trade simulator for the married put is a little exaggerated. Ernie's close to these numbers. In fact, Ernie's higher than these numbers. His average return on his trades over the last few years in the RadioActive Trading, the Fusion portfolio, his average win is about 11.4% and his average loss is 4.5%, and he's right about 60% of the time. Okay, and you can kind of see that when you look at the track record under Fusion, the numbers here. Let me clear this out for you. All right, so if I was doing a married put trade, now I'm going to use my numbers. They're not less realistic, but what I've experienced is my average winners are 7.1%, my average losers are 4.4% in the married put. I am right 60% of the time. Now, it's going to put in 100% invested per trade. That's okay. Now, my stock commission for if I open a married put would be $7.95. Now, if I'm going to factor in, Ernest, that I want to do weekly options with this, maybe selling weekly calls or doing a weekly bear call spread, the income method number 6 for something, usually what I expect to see is a 1% increase or 1% reduction in risk per month when I apply an income method. That's what I'm really looking for. So if I've been in a position for 2 months and I originally started off with a risk of 7%, I'm looking to do one of the income methods, I'm going to make sure that I'm doing it 2 months in and I have another 30 days to the expiration of the income method, for example. Well, I'm going to try to make sure that that income method is reducing my at risk by 3 or 4%, about 1% for each month, maybe 1 to 1.5% for each month. Okay. Now, why do I say that? It's because, well, I could say to myself, well, I'm going to increase this to 8.1% or factor in the 1% loss below it. I'm not going to do that, because my average wins and losses, 7.1% and 4.4%, are including all of the income methods and all of the adjustments, and I'm right 60% of the time. But I know that when I open the stock, I've got a $7.95 commission. This is my retirement account at Fidelity. When I trade an option, when I buy the put at $7.95, but if I do an income method, they usually put me up to about $8.70. So if I sell a call with income method number 1 or do the bear call spread, it's usually around $8.70. And the number of option trades, I'd count 1 for the put, 1 for the income method, and then maybe 1 for closing the initial income method. Now I might do 2 income methods, so I might bump this up to 4 or 5, but right now I'm just going to leave that at 1. So my stock commission when I first enter, my option commission, and let's say I do, okay, let's put it up to 4 transactions. Buying the put, doing an income method, maybe adjusting the income method, or having the income method expire, doing another income method, and I could even go up to 5 if I want to count in, closing the trade by selling to close the put whenever I reach my goals. Okay, we're going to leave that at 4, so total commission is $50. Let's go ahead and run that. And of course, you see that the biggest drawdown I have, even with commissions included, is $9,040. That's after 2 losses in a row. And of course, the high I could expect after 100 trades, keeping this win-loss ratio, the high at one point got up to 82, but we'd expect a reasonable gain, almost 8 times what we started with after 100 trades, if we're able to keep that target return. Okay, 63 and 37 as well. Now, even with factoring in the commissions, as I mentioned, Ernest, and you could put in different numbers as well. Honestly, if you looked at Ernie's portfolio, if you go through his track record of his closed positions, some of his transactions, the transaction count on some of his married puts are as high as 16. I think some are as high as 20. Now, there's not a commission for each adjustment. He'll sell a call, it'll expire worthless. The system counts that as 2 transactions. Really, it was 1. Okay, but the act of expiring the call counts as a transaction. We didn't have to pay a commission on that. But where I wanted to go with this now, this is being right 60% of the time. I'm going to put this right at 50, my probability of loss at 50, keeping the win-loss ratio I've seen over the past few years with my radioactive trades. And look, even being wrong more often than right, and factoring in all the commissions, at one point with a terrible string of losers, it looks like, going through at one point, I'm going to take this down to about 7,300, 7,400. It's almost a 26% drawdown. But even being wrong more often than right, that's still about an 80% gain from where I started. Okay, now let's get a worse one. Okay, there's a winning record. Yeah, here's a worse one. Even being right only 46% of the time, factoring in the commission costs. Okay, at one point we did have a large string of losers, we're almost down 50%, but we still could have come out with a positive trading record. Now again, we don't have to do this, but let's even compare that with making 3% when we're right and get assigned on a covered call, with using even a 7% stop loss, putting our probability of success being right 65, maybe even 70% of the time, but putting in 2 commissions for selling the call and then having it assigned or having to roll it, for example, 2 commissions for each one. How about that? Bankrupt after 61 trades. That's a covered call. Okay, so we got to be right more often. Let's go up to 70. Still bankrupt after 63 trades. 2 option commissions at 870, a stock commission factoring into the winners and losers. After 63 trades, we've just run out of money. And we're even being right 70% of the time. Okay, let's try this. Something is actually not working right here. Oh, thank you. Thank you. I always want to enter the probability of win. I went the wrong way. This is going to be better. Probability of loss. Okay. So probability of loss at 30%, not 70. All right, so right 67% of the time, making 3% when right, only losing 7% when we're wrong with a stop order, assuming we don't have any gap downs, factoring in the commissions. 67% of the time we were right. At one point we were up about 11%. We end up with a 67% loss, a 63% loss roughly. Wow. Okay, there we go. There's a winning one. Have to be right 75% of the time in a covered call. This is very similar to a naked put as well, right? Because you have the drawdown of the naked put if the stock moves against you. So when you're wrong and you have to adjust it, even if you keep this to 4 or 5%, you're still going to need to be right 70% of the time because you've capped the gain on the upside. And when you factor in commissions, it's really obvious. What are you fighting for after 100 covered call trades? A gain of 11%. Being right 75% of the time. So that just helps you show the effect, Ernest, of the commissions to any trading record. But of course, we saw with the married puts, when we put in the numbers we had for the married puts, being wrong more often than right, you can still make money even when you factor in the commission costs. Yeah, I mentioned all that, so I might as well just link to it. Let's just go to the track record here. And Ernie's track record, since we got introduced to RadioActive Trading, since he's been posting his RadioActive trades, okay, he's at 11% when he's right, 4.8% when he's wrong, and he's at 50-50 right now. But the results of plugging that into the trade simulator you see here, taking a $10,000 account after 100 trades, if he's able to keep this win-loss ratio and the target return and the target loss that he's been able to achieve, he could take the $10,000 up to maybe $128,000, okay? And of course, that's just simulation. And we go back one, and let's take a look at mine. Yeah, so it's 59 to 41, so pretty close to 60%, and 7.4%, I'm sorry, when I'm right, 4.4% on average when I'm wrong. So, you know, why is mine lower here, even though I'm right more often? It's because Ernie's target win is higher. He's able to get more wins on it when he's higher. He uses income method number one a lot more than I do. Every time I use income method number one, selling a call on the married put, I'd say 70% of the time I end up buying it back for a higher cost, because apparently I can pick stocks pretty well that move up in prices I'm expecting, but apparently I panic and use income method number one too soon. So that's just kind of the trade-off there. But it's something that's changed a lot this year from my past trading years. We did a whole new thing at the beginning of the year as part of the Blueprint bonus, where we did a review of what are the steps you should take to increase your trading performance, actually archived for Fusion subscribers and Blueprint owners. And essentially from what Kurt pointed out there, I applied that, set my goals and my expectations and changed my patterns for this year. And as far as the income method number one buybacks and such go, it's going much better. All right. So that's what the trade simulator does for you. So plug in your numbers, whether you're doing credit spreads, whether you're doing condors, plug in your expected return, that leverage return maybe you're looking at of 8, 9, maybe 11, maybe 15, maybe 20%, and then put in what your average is for a loss when you have to close a losing position. And I don't mean what is your loss, as far as you might say, well, I lost 100% on the condor. I mean more along the lines of, if you pay to close a position, what was that loss percentage-wise compared to what the maximum loss was? All right, if you take the full loss, it goes below both strike prices and your credit spread. That is 100% loss, but that probably just gapped against you. But if I was in a, if I was in a position, let's say a bull put credit spread, and I had a 5-point spread, and on average, I'm able to close my losses here for about $1.50. When I hit a loss, I close it for $1.50, meaning, let's say this is a 5-point spread, and we take in 50 cent net credit. So my true risk reward is 50 cents I'm looking to make against a margin requirement of 450. And that, of course, is that 11% return, but we have a 9-to-1 risk reward ratio. And if my goal is to close the position, one of my stops maybe is to close the position. If the debit to close the position reaches 3 times my expected profit, well, that'd be $1.50. But the $1.50 against the 450, that is a 33% loss. So maybe not even use 50, maybe use 33%. So you're looking to make 11% when you're right. You're risking 33% when you're wrong. And then take a look at what your percent winners are. And for most of you doing credit spreads, you're probably around the 70, 75, maybe even 80 percentile of wins. So your probability of loss in that case, you know, if it was you have 80% winners, your probability of loss would be 20%. And then plug in your commissions and run that through the calculator and see how you might expect to do over 100 trades. So target return, and then the loss, and then of course your probability. Well, we're here. Why don't we just do it now real quick? All right, so we're going to change those numbers up again. We're going to go back to the resources here. We're going to go back to the trade simulator. Okay, so 11.1% wins. Whoa, not 110. 11.1% when we're right, 33% loss when we're wrong. 33.3, let's be fair. Probability of loss, let's put that at 25. So we're looking for 75 winners, 25 losers. Now let's use our commissions. Stock commissions are none, but our option commissions, let's say, is $10.95 for a spread. And we usually have one commission to enter, but we may have another one later. But let's just put in one. So we see here, even with those numbers, taking the risk down to 33% by using that 3-to-1 of what we expected on the credit, and essentially taking a third of the max risk we could have taken. Even being right more often than wrong, twice as much as we're wrong. At one point would have thought we had a winning track record after the first 2 trades, but we almost went bankrupt. It's only $348 from the starting point of 10,000. Let's run that again. There we go. It's not a winning track record, but we didn't go bankrupt. It is a winning record. We're right 77% of the time, but at one point our accountants down about 32%, not 31% we'll call it, and at the ending we're still down. But you were right 77% of the time. Okay, and that's assuming that you only took a 33% loss on those 23 losers you had during those 100 trades. 70-30, not looking so good. 80-20, there you go. At one point, of course, you may have suffered down to almost 50% value from where you started at $10,000. At one point, you doubled it. And then again, we see where we saw before with that 80-20, you end up with almost an 80% gain. But because you're not controlling the risk, even being right more often than wrong, is still putting you in a position with those leveraged spread trades where you can get into trouble. Okay, so I just wanted to go over that too also in relation to the credit spreads and what you'd expect to make and what stops as well. And as I mentioned before, of course, in the free webinar section under the options strategies menu, there's webinars there on our thoughts on managing your spread positions, rolling your spreads, for example, and making other adjustments. Okay, now to get back to another point of Ernest's questions. Can I use weekly options in a married put? Well, he wanted to see how you could simulate, but he also was asking a basic question. Can you use weekly options with a married put? Of course you can, but you still want to make sure it matches the rules in the blueprint. Because if you try to force a trade, okay, if you try to force an income method, force an adjustment on the position just because weekly options are available, you can put yourself in a drastically worse position. Okay, what do I mean by that? Let's take this one, DICOM. I think this is one Ernie opened recently. The stock's currently at 71.24. And to follow the rules of the blueprint, we could buy the March 80 put at 7.8%. I don't know if they have weekly options, but we're going to find out in just a second. I'll use Lowe's if they don't, because I'm pretty sure they have it. Let's check out DICOM here. We're going to go to the profit and loss chart and watch me be disappointed because they don't offer weekly options, and then we'll just change to another stock that does. Okay, so let's do this. I'm just going to do Starbucks on the fly. I know they offer them. All right, so Starbucks. And I don't know the current price today, but let's take a look at the options for Starbucks. It's at 58.08. If I was opening a married put on Starbucks today, I'd probably go out to April or June. I want to go at least 150 days out, but open a new married put, RadioActive Trade. I'm going to start with April. We're going to buy 100 shares of stock at 58.08. At the same time, I'm going to buy in April. Oh boy, let's try the 62.50 at $7.05 at the midpoint. It's probably going to be a risk higher than I want, but we're going to go ahead and try it. Okay, so 58.08 for the stock, 7.05 midpoint between 6.95 and 7.15 for my put. Let's go ahead and see what that would look like. Oh, well, the risk is pretty good, actually. I like that. Okay, so we've got a small risk of 4% on the Starbucks position. Stock's trading at 58.08, and we're holding the 62.5 put. Now, we know Starbucks offers weekly options. I paid $7.05 for this 62.5 put. But remember, $4.40 or so of it is time premium. Is intrinsic value. All right, we've already got that because we're guaranteed to get back out at 62.50. But that remaining $2.63 of time premium is our true risk. Now, am I down $2.63 when I first opened this position? No. My break even is the total cost base $65.13. That's if and only if I hold the position all the way to April expiration and make no adjustments between now and then. All I'm risking when I open this position is the bid-ask spread and what the stock does next. Okay, I could turn around and liquidate this position, probably sell the put at $6.95 and sell the stock at $58.08, and I'd only have a 10-cent loss. Okay, so I'm not behind the 8 ball immediately by $2.63. Now, we're going to ignore today, obviously, because it expires. So next week, October 9th, the stock's at 58.08. We bought the 62.5 put. We need to make up $2.63 over time. So why don't I go ahead to October, and with stock at 58.08, let me go ahead and sell the 59 call. Not a lot of premium, 30 cents, but if I go to the 60, it's only 10 cents. And if I go up to where my put is, it's probably 3 cents. All right, so we're going to try to get 30 cents right now for the weekly option. So we had a risk of 263. We're going to generate 30 cents against it, so that should drop our at-risk amount on the downside to 233, right? So our risk should be 233 now. Everything looks good. No, it doesn't. What happened to my risk? It's not down to 233. It moved up to 583, or 9%. How? I did reduce the risk to the downside. We had original risk of 263. We took in our 30 cents, so our risk to the downside now is 233. If the stock drops to $1 per share, or drops significantly in price. This risk now is to the upside, in the original direction you thought the stock was going to go. You still have a cost basis of 64.83. You sold a 59 call because it's the only thing that offers a good premium for the next week out, but you had to sell the 59. If the stock gaps up in price, your put is going to decline in value significantly, and you get no more positive delta from the stock, and so that's why the risk increases to the upside when you sell the call too soon and try to force it just because weekly options are available. You still want to follow the rules in the blueprint for when you'd use income method number 1, income method number 6, income method number 5, or any of the other ones as well. You want to make sure the rules are met. Don't force an income method just because there's an income method available. So we could go out to 2 weeks. Is that going to look any better? Maybe. But here's part of the other problem I wanted to illustrate. When I originally opened, if I did open this position, if I opened the Starbucks position initially, buy the stock at 58.08, buy the 62.5 put for 7.05, it's because I had the expectation that this stock was going to move up 5 to 8% within the next 20 to 45 days, or 30 to 45 days or so. Okay, I'm expecting a gain of 5 to 8%, which of course would put me right around $60 to $62 per share. All right, right near my put. And at that time, I'd look to maybe sell a 62.5 call at a higher price because the stock has moved up. When I sell this call too soon and at too low of a strike price to collect a measly 30 cents just because weekly options were available, I cap my upside gain to only 0.9%. Okay, so we generated 0.4%, about 30 cents on our investment would be about 0.4, 0.5%. And we capped our gain at 0.9%. Let me show you something else very quickly here. Let me do this. Whoops, sorry folks, just selected the wrong item here. Let me go ahead. Oh. There we go. Okay. I'm just going to do this real quick while everyone's there. I just want to change something up here on the screen behind the scenes. A lot of comments I get, for the past 6 years since I've been trading radioactively in my own personal account and advocate this techniques. The reason I keep trading radioactively in my personal account is because my performance radioactively has outperformed everything I've ever done. About 1.5 years to almost 2 years of covered calls trading, 2 years of naked puts investing, doing credit spreads in my portfolio, calendar call and calendar put spreads, trying to follow the market with calendar spreads as well. And even credit and debit spreads. The married put techniques have outperformed, just for me personally, what I've done in those strategies. Now, when I originally show the married put here, the first comment I always get during a webinar, if I'm hosting with Kurt or if I'm hosting my own webinar and we show this, the first comments we get is, why would you buy a put if you're bullish on the stock? You're trading against yourself. You've added too much to your cost basis. You're not going to make any money. Your break even is now 7 points higher than the stock is trading. It doesn't make any sense. You're trading against yourself. No, I'm insuring a $5,000, or let's call it even a $5,800, or in this case even a $6,500, even a $13,000 investment, so I can't lose more than maybe 3.5 to 7.5%. I'm insuring an investment. That's not trading against myself. Adding protection and then selling a call at too low of a strike price and too soon is trading against myself, because everything I did to research this position was based on I wanted the stock that I felt had the best chance based on my analysis to go up 5 to 8% in the next 30 to 60 days. Why would I cap my gain to 0.9%? It's not even that I cap my gain to 0.9%. The max I could make right now is 0.9%. I know I'm not counting adjusting the short call, but this graph is going against everything I just set up. I cap my gain to 0.9%. That only occurs if the stock's trading right at $59 in the next 7 days. What are the odds of that? I mean, right at $59. What are the odds? Okay, it could be at 58. It could be at 59. It could be at 58.10. It could be at 59.20, right? But the odds of it being right at 59 are very small. I've taken a drastic risk. I've more than doubled my risk to the upside in the direction I thought the stock was going to go. But I just did all my research and analysis. This is where I think the stock's going to be trading in 20 or 30 days. Why on earth would I do this? Even if it's only 7 days or 14 days out, why would I do that? That's trading against myself. Trying to force the call in a protected position just because it's there and just because weekly premiums are there. That is trading against yourself. You're putting yourself in a much worse position to try to generate a small premium because we have this idea that we're not going to be able to generate income, that the stock's not going to go in our desired direction. We have to generate income now to pay for that insurance. Now, I'm going to wait. I'm going to wait to see if the stock does what I expect, and if it does, I'm going to be able to do much better premiums, put myself in a much better position. And if the stock doesn't do what I want and it falls in price, that's what the blueprint teaches. I've got other methods that I can use to adjust the position to the downside. And the stock does stagnate right at 58, well, okay, your call expires worthless, but I've got other adjustments I can use on the stagnating stock to maybe put me in a better position as well. Okay, so all that being said, let's say that I originally got into Starbucks at $53 per share a few weeks ago, and at the same time, maybe I bought, let's say 30 to 40 days ago. At the same time, when I got in at 54, I bought the 53. We bought the January, we'll call it 55 put, let's see here, for $370. Okay, so, let's change that. I'm sorry, let's do that a little bit better. I'm sorry, let's go back to January. My apologies. Let's go to 57.5. That would have worked better, but it would have looked exaggerated, so I'm going to be more realistic. With the stock at 53, 4 points in the money here, so let's call that roughly $6 at the time, $6.20 for that put. All right. Trying to get this more realistic number. Good. Okay. So, shares of stock at $53. At the same time, bought the January 57.5 put for $8.20. Now, we had a risk of 6% on this position, and the stock's trading at 58.08. Well, can I use weekly options now? Of course. I waited for the stock to move up as I expected. And what if I sold the 59 call now for 30 cents on this married put after waiting for the stock to move up, the 5.8% I expected? Not getting a lot of premium, not reducing the risk that much, but now I've got a much better risk-reward profile. We've got a much wider upper and lower break-even. Not much more of a gain, but this is a better profit and loss a little bit because it's not really truncated where the break-evens were so close together. And because my cost basis was realistic, I waited for the stock to move up, I get a slightly better risk-reward profile. Okay? Now, I wouldn't probably do that in this case because it's only 30 cents. I might go out to the October 16th, 14 days out, which is standard expiration. Let's just call it 2 weeks out in time, or maybe even 3 weeks out in time, and get about 84 cents for the 23rd of October. Okay, how would that look? It's going to look much better. Okay, so now in this position, you might say, we just took the October 23rd, get a 1.7% for about 3 weeks. We've lowered our risk down to 4.8%. Pretty wide upper and lower break even there on our position. Now, you might look at this and say, well, you only collected 84 cents for going 3 weeks out. And if you got that 30 cents for October 9th, October 16th, and this October 23rd, if you're able to get 30 cents for each one, you'd have 90 cents. You'd have a higher total premium. Well, you'd be right. But in the real trading world, what have I got? I've got 100 shares, because that's all I allocated to the Starbucks position, 1 put and 1 call. If we saw earlier, my commissions are $8.70. Okay, let's just call it $9 even. Let's be nice and just call it $8 even. Okay, so if my commission are $8, and assume everything works out where I could sell the October 9th, the October 16th, and the October 23rd all in a row for 30 cents a piece, and they all expired and I kept the full premium, well now, when we factor that in, this would be 22 cents and 22 cents and 22 cents. We get a total of only 66 cents. We subtract the one $8 commission from my 84-cent net credit, we get 76 cents. Okay, so in the realistic world, when you're trading only 1 or 2 contracts and the weekly calls you're trying to force are only 30 or 40 cents, even if you're doing maybe up to 3 or 4 contracts, you have to factor in the commissions, because what you'll probably end up seeing is that it's okay to go 3 weeks out in time. Now, does that go against the concept of weekly options? In one sense, and that one sense is that one of the advantages of selling calls week by week is that you have less time for the stocks to move against you. This week I had a roller coaster of a ride with Cal-Maine. I'll tell you what, on Friday, last Friday, it was at $58 per share. We had earnings coming into Monday. Earnings came out on Monday after the market. I used income method number 12 on the position to sort of create the long strangle position, or what Kurt calls the smiley face. And the stock plummeted after earnings down to $50.26 per share. Okay, so I had a 50 put that went up from 40 cents to about 40 cents when I bought it on Friday to $2 as a high on Monday. Okay, because it was pre-market. I'm sorry, it's Monday pre-market. The earnings came out. So all day long, it just dropped. Well, because of that income method number 12, I could have gained another $1.60 against the put position, or against the Cal-Maine position. Over the last 4 days, the stock's moved up at about $1.50 to $2 a day, and today it was up $3. It's back up to $59.50 after it took an 8-point tumble. There's a lot of money to be made on that position, but why I'm bringing this up is there's no way I could have calculated using a 7-day trade, a weekly option, what it was going to do. Because if I bet bullish, I would have lost on Monday, and then if I bet continuing bearish, I would have lost the next 3 days. I would have had to change my sentiment very quickly. I didn't expect the stock to drop almost 8.5 points from earnings. I took the chance that if it did, I was in a better position, of course, but I didn't expect it to gain another $9 back afterwards. It's just, we're going to wait to see what happens on Monday again. It could go anywhere, so it'll be interesting to see. But when you're using these weekly options, you look at the chain, and we can look at it here very quickly. We saw that the October 9th, 7-day out, 59 call, we're going to call that 30 cents at midpoint. That's great. It's going to have a very high annualized return if you get 30 cents every 7 days. But if you're only doing a few contracts, if you factor in the commissions of selling it at 30 cents here, and then you get to October 9th and it expires, then you sell the October 16th for another 30, and then you sell the October 3rd for another 30, well, you've got 90 cents of premium compared to 84 here at the midpoint. But when you take in your commissions of $7, even $5, right? So this would put us down to 79, and 15 minus the 90 we received would put us down to 75. Selling this one 3 weeks out is still a better deal because you're paying less commissions on the smaller premium. Okay, so you want to factor that in. Don't. One of the webinars I have on weekly options, the quote I use is, don't trade weeklies for the sake of trading weeklies. Okay, make sure they match what you're doing in your portfolio. So a lot of those weekly options are very, very small premiums. Yes, you'll get a better annualized return mathematically, but when you factor in the real cost of trading, you might be better off just selling the 2 or 3 week out option. That's as simple as it is. And if you've got 10 contracts or 20 contracts, that's probably not an issue, okay? But if you're just doing protective positions and looking for rollout opportunities and the income methods with the radioactive trading techniques, and you're only doing 100 or 200 shares, those commissions are probably going to factor in, and you want to be aware of that. So what I just wanted to show you is that yes, you can use weekly options in the radioactive trading techniques. In fact, last year I used them several times with Johnson & Johnson. Ernie, I think, used them recently with Facebook. You can do them, but they still have to match the rules in the blueprint. Just because weekly options are available doesn't mean you should enter any adjustment on the weekly options as soon as you open your married put. You don't want to do that because you'll probably end up hurting yourself and putting in the position in a worst possible win-loss ratio than you started out with. All right, well, ladies and gentlemen, it's 5:29 p.m. Eastern Time. I don't see any other questions that have come in from our audience. If you have any last-minute questions, please feel free to go ahead and send those in now. I'm just going to go ahead and navigate back over to our slide presentation here. I just want to remind everyone online, if you haven't done so already, or even if you had a PowerOptions account in the past and haven't checked us out recently, You can go to PowerOp.com at any time and just register for the 14-day free trial. You have full use of our tools for 14 days on the 20-minute delayed service. Of course, after that, our subscription cost, we have a 20-minute delayed service, which is $60 per month. Our 20-minute service plus the historical tools, where our historical searches and the different strategies, historical search by symbol and historical option chain, those all go back to 2006. So the 20-minute delayed plus access to the historical backtesting tools is $100 per month, just $40 more. We do, of course, offer the real-time service. That's $100 a month by itself. And then if you wanted to upgrade to the real-time plus historical, that's $140 per month. Right now, of course, we do also have an end-of-day service. If you're just testing out, you're just trying to practice with trades, the end-of-day service, of course, only updates once a day, and the end-of-day service is $40 per month as well. Now, I'm going to have to correct this. I do apologize. This is not here. We're actually not going to be able to do, well, no, I'm sorry. We are doing a presentation on Monday, but it's going to be more along the lines of using the portfolio tool. Tuesday at 12 noon, Kurt's going to have a radioactive trading position, as he always does. And Wednesday at 12 noon, we're going to have a different strategy one. It might be on diagonal versus horizontal spreads, calendar spreads, for example. We'll take a look at that. Okay. And last but not least, again, I didn't see any last-minute questions come in. So if you do think of any questions later on, please feel free to contact us at any time. You can send us an email to support@powerop.com. Remember, you can also call us during market hours at 302-992-7971. There's also contact links on the bottom of every Power Options page. Well, thank you again for joining me this afternoon, ladies and gentlemen. Have a fantastic weekend. For those of us here in the Mid-Atlantic and the Northeast and along the Eastern Seaboard, stay dry and stay warm. Going to have some heavy winds in the next few hours for some of us, and a lot of rain still coming in as well, especially those of you down in the Carolina area and Virginia, if anyone's here. So take care there, stay dry, watch the flooding, and watch the winds as well. And we'll see you all next week on one of our other presentations. Have a happy trading week next week, folks. We'll see you soon. Good night.